Hi everyone, in this video I'm going to introduce you to corporate business income. Once we determine corporate business income, then we'll be able to determine taxable income and subsequently taxes payable. So this is the first step along the way. Here are the learning objectives for the video. Number one, to identify amounts that should be included in business income for a corporation. We're also going to want to identify any amounts that are deductible in determining business income for a corporation. We should ultimately be able to prepare a Schedule 1 for a T2 corporate tax return, and this gives us the business income for a corporation within this schedule. And ultimately the goal here is to reconcile net income for accounting purposes with net income for tax purposes for a corporation. We'll worry about taxable income, taxes payable later on. So how does determining business income for an individual, which we determined many months ago, differ from determining business income for a corporation, which is the subject of this chapter? Well, individuals, as you'll recall, complete a T2125 statement of business activities on their tax return. It generally comprises one component of their overall net income. Corporations will complete something that's called a Schedule 1, which is a reconciliation of their accounting income to their net income for tax purposes on their corporate tax return, which we call a T2. Now, individuals normally use a calendar for business income reporting, whereas corporations can choose any year-end as long as it doesn't exceed 12 months. The example that we're going to look at, they've chosen a December 31st year-end, but please note that this isn't necessarily required for corporations. Corporations must choose or can choose any year-end. So frequently you'll see a year-end that is June the 30th or July the 31st or something along those lines. So what is this Schedule 1 going to look like? Well, what will happen is you'll start with accounting income. That's your key starting point, and that's going to be from the financial statements, or more specifically, the income statement. And accounting income is determined using generally accepted accounting principles. That's fine. We start there. Then we take a look at revenues. Any revenues that are considered non-taxable need to be removed from income. There's not very many of these, so we're not going to have to worry about this too much. You would then add in any revenues that weren't included in GAAP revenue, but would be considered taxable. And this makes sense. So you start with accounting income, and any revenues that were in there that are considered non-taxable have to be taken out. Any revenues that were not included in GAAP but are considered taxable would have to be added in. So revenues, honestly, not a main focal point. What we're usually looking at is expenses and how the treatment differs for accounting purposes and tax purposes. So what we're going to do is we're going to have our running reconciliation going here, and then we'll be taking a look at expenses. Now, any expenses that were deducted for accounting purposes but are not deductible for tax purposes, we're going to add back. We are then going to deduct any items that are not deductible for accounting but are deductible for tax purposes. And I'll go through a list of a few of those as this video progresses. The summation of all of this is going to equal our net income for tax purposes, and this is specifically business income. But as you'll see, hopefully right in the next slide, effectively for a corporation, for right now, the net income for tax purposes generally is just business income. They can potentially have other types of income as well, but for the most part, we're just looking at business income. For individuals, you guys are, I hope at this point, pretty accustomed to seeing this particular slide, which gives us the calculation of net income for tax purposes. So where we're focused right now for corporations is effectively, it's the same, but we're just looking at business income. We're not going to have any employment income. Property income is possible, but we're not going to deal with any of this stuff for now. There's going to be no other income. We're not going to worry for right now about capital gains. There's no such thing as other allowable deductions. There's no such thing as employment losses. A corporation can't be employed. There could potentially be property losses, but I don't want to worry about that either. So potentially you could have a business loss. Potentially you could have business income. That's effectively going to be your net income for tax purposes. All right. We're going to keep it simple for now. Here we have an example where I'm going to try to demonstrate the difference between corporate and individual business income by showing you and reminding you, I should say, first, how an individual would submit their business income, revenues, and expenses for tax purposes, and then we'll take a look at how a corporation does it. So our example here, we've got an individual taxpayer, and they're coming to you to prepare a T2125, which, as you all know from your assignment, is basically an income statement for tax purposes, right? It's where business revenue and expenses are declared for tax purposes for an individual. So we've got some sales of 20 grand, and this is interesting here. They've performed services of $10,000, which they haven't invoiced. They also have meals and expenses of $4,000. They have rent of $6,000 and insurance of $3,000. Depreciation expense is $6,000. CCA is $4,000. So how would you calculate the business income for an individual taxpayer using a T2125? We'll go through it on the next slide. So how would we determine the net business income for this individual? Well, we'd start with sales. We have $20,000 worth of sales received, and we know that we've got $10,000 of sales that were earned but not necessarily billed. So for tax purposes, and regardless of what these people or this individual has done for accounting purposes, for tax purposes, we know that we need to use the accrual system for recording revenues. So in this case, it doesn't matter whether or not they were paid the $10,000 or whether they billed it. If the service is performed, it must be included in income. Now, this is pretty normal accounting practice as well, but some individuals don't necessarily know this and maybe they're doing it wrong. So we just have to make sure we record all the sales here for tax purposes because they will be taxed on them. All right, so then we're going to deduct expenses. For tax purposes, we deduct CCA, not depreciation. Meals and entertainment expense is half of the amount that was deducted for accounting purposes. So whether or not they incurred $4,000 worth of meals and entertainment expense, you can only deduct half of that, as we know, for tax purposes. Rent is $6,000, insurance is $3,000. The total of all these is $15,000, giving us net business income of $15,000 for the year for this particular individual. Now we'll take a look at how a corporation would generally prepare their net business income statement for tax purposes. It's a little bit different than how an individual does it. So again, we're going to be completing, as a corporation, the corporation would complete a T2 tax return, and in specific, they would complete what's called a Schedule 1, where we start off with accounting income and then reconcile that to net income for tax purposes. So we'll take a look at this example here where we've got this taxpayer. They've come in, they've got their corporate income statement for accounting. Right? Just a regular income statement that you guys would be used to from your accounting courses. They also inform you they have $10,000 of services performed which have not been invoiced and accounted for. Now this is weird. I'm only putting this in here to demonstrate what you would do with this if you actually encountered this. This person, for their corporation, doesn't seem to be accounting for transactions using generally accepted accounting principles, which of course is wrong. But I just wanted to demonstrate some of the ideas behind how business income is recorded for tax purposes within a corporation. So we've also got information regarding CCA having been correctly calculated as $4,000. So let's take a look at that income statement. It's just a regular income statement now. Here's the sales. They don't include that $10,000, so we're probably going to have to deal with that. Depreciation, which of course is an accounting expense, we're going to have to do something with that. Meals and entertainment, 100% has been deducted. We've rent, insurance. Finally culminating in our net income on the accounting financial statements of $1,000. We're going to see that this is actually going to be different for tax purposes. You're not going to have the same net income number for tax purposes you will for accounting purposes. So let's go ahead and do that reconciliation right now. So let's take a look at the reconciliation for the T2 Schedule 1. So what's different here is that we are going to start with, when we're dealing with a corporation and a Schedule 1, the net income for accounting purposes. Now that's $1,000 as per the income statement on the last slide. What we're then going to do is make adjustments to come to our net income for tax purposes. So the first thing that we'll do is we'll add back items that should be taxed. And the first thing is that revenue that wasn't accrued. For tax purposes, you must accrue revenue, so we're going to add in $10,000. The next thing is we're going to add back depreciation expense. Now, why are we adding this back? Well, depreciation expense is an accounting expense that was deducted in order to arrive at the $1,000. For tax purposes, we have to deduct capital cost allowance. We know this. So what happens is we add back depreciation expense, and later on we will deduct capital cost allowance. So in addition to that, we had meals and entertainment expenses on the accounting financial statements for $4,000. We know we're only allowed to deduct half of that. So what we do is add back half of the meals and entertainment expense, which is $2,000, half of $4,000. Our total additions are $18,000. Then we're going to move into doing some deductions. Now the only deduction that's relevant here, and we'll learn about more of them, is, of course, as discussed, the capital cost allowance. So we deduct $4,000 for capital cost allowance, and this is going to give us our net income for tax purposes of $15,000. Easy, right? It gets a little more complicated, but this is the basic formula that you're going to use for every T2S1. So let's move on to a more comprehensive example. We're going to be working with a company called TriStar for the next, well, basically the rest of the video, and we're going to incorporate every possible example of a deduction or addition on the Schedule 1 into our ongoing TriStar example. So I give you guys a handout in the worksheet section on D2L. You can click the link here, or you can just poke through D2L and find it. It should be fairly straightforward. We're going to take a look at their December 31 year end. We've got net income for accounting is $742,000, and that includes a $26,000 tax provision. And so what we're going to do in the required here is complete the T2 Schedule 1 reconciliation using various information provided in the subsequent slides of this video. So you'd probably be advised to go and open up that handout, and you can follow along with me if you want, keeping track of things, items that we're going to be adding back and deducting in the TriStar example, T2 Schedule 1. All right, let's go do it. So let's talk a little bit about revenues and how they're treated for tax purposes and various effects that we're going to have on the T2S1. Now, revenues have to be recognized, as mentioned before, on an accrual basis. In all likelihood, this would have been done already for accounting purposes. So there's a very strong chance you're not going to have to do anything with revenue. Just keep in mind that if anyone's been keeping track of revenue using a cash basis, any accrued revenue needs to be reported for tax purposes. Now, accounting gains on sales of assets are not taxable. They're not taxable items. This is all dealt with. Any disposition of a capital asset, as we know, is dealt with through the CCA system. So, given that, we must deduct any gains in the financial statements on Schedule 1, right? They were added in to come up with accounting net income. They must be deducted in order to come up with our taxable income. Good. So the way this is dealt with, as you guys will recall, is taxable capital gains could potentially result from the sale of capital assets. It's all dealt with through the CCA system. We could potentially have recapture as well. So taxable capital gains are going to be included in Schedule 1 as income. Remember that it's only half of the actual capital gain that will be included, and recapture is going to be added on Schedule 1. It's very important that recapture is added on Schedule 1. That is a business income inclusion, if you'll recall. Now, accounting losses on the sale of assets are not actually deductible for tax purposes. So what you have to do, if they have been deducted for accounting purposes, is add them back on the schedule. This isn't a problem. It comes up quite frequently. You guys should be on the lookout for losses and gains on the disposition of these assets. Now, for tax purposes, how they're dealt with is that we may have allowable capital losses. Remember, depreciable assets never have capital losses that are allowed on them. But on shares and land, you may have allowable capital losses. And then what's more likely is you could have a terminal loss. And now terminal loss must be deducted on Schedule 1, as it is a deduction from business income. Let's take a look at how these items work on our T2 Schedule 1 example with TriStar. Here is some information about equipment that TriStar sold during the year. We've got accounting net book value of equipment, as well as net book value of delivery truck that was sold throughout the year. Oops, I crossed. Let's do that. Oh, that's a much nicer underline. So we've got equipment information down here. We've got the proceeds, what it was sold for. We've got what it originally cost, and we've also got the undepreciated capital cost at the time of sale. For the truck, we've got it was sold for 35, the cost was 50, the UCC was 48 grand. What's important to note here is the truck is the last asset. in class 10, meaning there could be potential for some terminal losses, recapture, etc. And we need to figure out what is the impact, and we're going to be doing a lot of this now. What's the impact to TriStar's Schedule 1? So let's take a look at that right now. Let's start off by examining the equipment. So for accounting purposes, we need to figure out, was there a gain or a loss on the sale of the equipment? We can do this by comparing what we sold this for with its net book value. So the book value was 13 grand, the proceeds were 25, meaning we had what? An accounting gain of $12,000. This is not a taxable item. Right now it's included in the accounting financial statements. We're going to need to deal with this. The effect on the Schedule 1 is we're going to deduct $12,000 from accounting income. And I'll show you what that's going to look like a little later on. Next up, I want to take a look at the tax ramifications. So for tax purposes, we had an opening undepreciated capital cost balance of $19,000 on this equipment. We need to then remove from the pool, right, the lesser of cost, and this originally cost $40,000, or the proceeds of $25,000. Now the lesser of those two things is $25,000, comes out of our UCC pool. What happens here? We create a negative number and recapture of $6,000. As stated before, recapture is going to be added back on our Schedule 1. We're going to add $6,000 to accounting income on the Schedule 1, and those are the effects of the transactions involving the equipment. Let's take a look at the truck next. Let's take a look at the tax ramifications on the Schedule 1 of the disposition of the delivery truck. So for accounting purposes, again, we got to figure out gain or loss included in the financial statements. Proceeds, we sold this truck for 35 grand. Book value, 42 grand, leaving us with an accounting loss of $7,000 that's buried somewhere in the financial statements. That's a no-go, so we're going to have to add back $7,000 to accounting income. Now let's take a look at the tax ramifications here. We had an opening UCC balance of $48,000. Again, we're going to subtract the lesser of cost, and this thing costs $50,000, or the proceeds of disposition, which is $35,000. That's much less than the UCC, so we're going to end up with a terminal loss of $13,000. Because we have a terminal loss, we're going to be deducting that from our accounting income on the Schedule 1. Overall impact on the Schedule 1 is going to look like this. We start off with net income for accounting from our income statement. That was $742,000. We then add back the accounting loss. We add back the recapture. We're going to deduct the accounting gain. We're going to deduct the terminal loss. The overall effect here is we have two additions and we have two deductions. And I believe there's a net $12,000 deduction that happens here, but because we're going to see several more examples involving TriStar, I will tie these all in at the very end, and we'll show them on one big spreadsheet where every addition and every deduction from accounting income ultimately reconciles with our tax income. All right. I'd like to talk about expenses now and general limitations that are put on expenses that are incurred for tax purposes and their deductibility. So if an expense has been deducted for accounting purposes, but it doesn't meet general limitations for tax purposes, it has to get added back on the Schedule 1. And this is going to be a very common thing that we do when we're doing our T2S1 reconciliation. So expenses, like revenues, are deductible based on the accrual basis of accounting, so they should be deducted when the expense is actually incurred, not specifically paid out. In order to be deductible, an expense has to meet the following criteria. They have to be incurred by the tax-paying corporation to earn income from business or property. They have to be related to the business or property. So it can't be expenses on behalf of some other business. It has to be for that specific corporation. Can't be a personal expense. That can't be run through the business expenses. Can't be a capital expense, capital assets, etc. We'll talk about how capital assets are treated, but we know that's through the CCA system. And has to be reasonable given the circumstances. We're going to talk about a general reasonability clause, something like meals and entertainment, which while for accounting purposes you can deduct 100%, for tax purposes the Income Tax Act says, well, 100% is a little unreasonable. 50% seems more reasonable. So we'll look at some more examples of that coming up. Let's take a look at an example within TriStar of an unreasonable expense that's been deducted for accounting purposes but can't necessarily be deducted for tax purposes. So we have the owner of the company his name is Manuel, hiring his daughter over the summer to drive an excavator. She's paid 40 grand for the 4 months, not each month for the total, so $10,000 a month. And they're normally paid about $2,500 a month, so this would probably be the fair market value of the services. So we have to make a comparison. We have to ask, well, is it reasonable for this guy to pay his daughter 10 grand a month to drive an excavator when the majority of people who are driving these things are only paid $2,500 a month? And the Income Tax Act says, no, you can't really do that. So what are the Schedule 1 adjustments that we have to make here? Well, the amount as stated paid to Manuel's daughter would be deemed unreasonable because the fair market value of those services was only $10,000. $2,500 a month, 4 months, $10,000. The difference between what Manuel deducted and what the actual fair market value is needs to be added back for tax purposes. So we can figure that out pretty easily. We're going to add back $30,000. $40,000 is the amount he paid, which was unreasonable, minus $10,000, which is the fair market value. So $30,000 in total was considered unreasonable and is added back to accounting income. Let's talk about a few expenses that are not permitted to be deducted at all for tax purposes, whereas they may be allowed for accounting purposes. The first one we'll look at is charitable donations. So this has to be added back in our net income calculation. Usually when we come up with taxable income for a corporation, it's deductible, but we'll talk about that later. For now, what's important is we have to add it back to net income. Next up is political contributions, not deductible from corporate business income. Income tax expense is not actually a deduction that you can make. So if that's included in net income for accounting purposes, you definitely have to add that back. Amortization or depreciation expense for accounting we know is not a permitted deduction. Interest and penalties to the CRA, those are not permitted deductions. Fines and penalties levied in Canada and abroad. So any fines or penalties that are incurred cannot be deducted for tax purposes. Any capital items, and we're going to talk about those very soon, can also not be deducted for tax purposes. Those are dealt with through CCA. We'll talk about that next. Let's apply some of this theory to TriStar. So we've got charitable donations of 16 grand that they expensed during the year for accounting purposes. Also included in net income is depreciation expense of $65,000. They have an income tax provision of $26,000. And my question for you is, what are the Schedule 1 adjustments? Well, none of this stuff is allowed. So donations, depreciation, income tax expense, none of them are deductible for tax purposes. Therefore, they all have to be added back. So the effect on the Schedule 1 is going to be to add back the 16, add back the 65, add back the $26,000 to our accounting income. Let's talk a little bit about capital expenditures now. So capital expenditures are not deductible for tax purposes. They have to be capitalized, and then they're subject to the CCA/undepreciated capital cost system that we're so familiar with. So what are some related capital expenditures that we're not actually allowed to deduct? So the purchase of capital property, obviously capital assets, right? Land, machines, vehicles, whatever. You can't deduct that. It has to be capitalized. If you write down capital assets, you can't actually deduct that for tax purposes. That's not how it works. So any write-downs would have to be added back. Any appraisal fees when valuing an asset for sales. So this would be deductible if it was required for insurance purposes, but otherwise it's not. Again, it's part of the capitalization of the asset. So if that was deducted for accounting purposes, you'd have to add it back. Any incorporation costs are actually capitalized, so those can't be deducted. They'd need to be added back. Any amendments to the Articles of Incorporation, any expenses related to that need to be added back. Any major expenditures made to extend the life of our fixed assets, right? If it's repairs, it's expenses. If not, if it's actual improvements which extend the life, then that has to be capitalized, so they can't be deducted for tax purposes. Okay, let's take a look at how this relates to TriStar with some simple examples here. So we had older equipment that was written down by 6 grand for accounting purposes. In addition to that, in order to determine the saleability of the equipment, can we sell it or not, the equipment was appraised. The appraisal fee was $1,200 and it was expensed for accounting purposes. How is this going to work for tax purposes? Do we have to adjust on the S1? Of course we do. Neither of these things are deductible for tax purposes, so you got to add both of them back. The effect on the S1, add back 6 grand and $1,200 respectively to our accounting income. Easy. Some other deductions that are not permitted for tax purposes but are for accounting are life insurance. So if as a corporation you are paying for life insurance for the CEO or the CFO or some employees, that's not actually a deduction you're allowed to make. If you are as a corporation buying or paying for life insurance premiums for all the employees, or if a bank requires you to purchase life insurance as collateral for a loan, then yes, it is in fact deductible. Otherwise, this is a no-no. Any kind of yacht, camp, golf course expense incurred. So even the usage of a yacht, any expenses paid for that, any expenses paid for golf whatsoever that may be deductible for accounting purposes, definitely not deductible for tax purposes unless that's your business, is, operating a camp. Then okay, you can deduct that. Club memberships. If the primary purpose is recreation or dining. For example, if your corporation is purchasing memberships to the local curling club for as a perk, that's not a deductible business expense, so you can't do it. You'd have to add all that back. There are other expenses whereby a deduction is permitted, but it is limited, and the one that we know about is meals and entertainment. 50% of meals and entertainment is deductible, except for events where all employees are in attendance, which are in fact 100% deductible. So if 100% of meals and entertainment expenses were actually deducted on the income statement for accounting purposes, then we must add back 50% on our Schedule 1.
We also have some limitations in relation to some automobile expenses that could potentially be incurred by a business. So the first one is for leased vehicles. The maximum deduction that's allowed in the event that a business or corporation is leasing a passenger vehicle is $800 per month as a deduction. So if any more than $800 a month has actually been deducted on the income statement, you have to add back the difference on the Schedule 1. And we're going to see an example of that in the subsequent slide. In addition to that, we have limitations that pertain to automobile allowances. Now you remember these automobile allowances from way back in employment income. Automobile allowances were included potentially in employees' income, depending on whether they were reasonable or not. From the perspective of the corporation, when they're paying out these automobile allowances, they must be based on specific prescribed rates in the Income Tax Act, and these prescribed rates change annually. So for the current year, the prescribed rate for the first 5,000 kilometers maximum deduction is listed right here. And then for any amount of kilometers that are driven greater than 5,000, we have a reduced rate shown right here. Any amounts that have been paid out as an allowance that exceed these limitations have to be added back on the Schedule 1. Now this might seem complicated. Let's have a look at how it actually manifests itself in the following slide. Let's see how these particular rules manifest themselves in the TriStar example. So for the year, we had included in TriStar's automobile expenses were the cost of leasing a vehicle, which were deducted at $1,000 per month for a total of $12,000, as well as we had some mileage that was paid to employees of $14,000. Now that $14,000 seems to have been based on the fact that the employees drove 25,000 kilometers and they were paid 56 cents per kilometer. And we know that that actually exceeds the prescribed rates for both of these expenses within the Income Tax Act. So we've got $1,000 a month when we know that the prescribed rate is $800 maximum. And we also know that we have limitations on the amounts that can be deducted in pertinence to a automobile allowance. So let's take a look at the required Schedule 1 adjustments for both of these expenses. So we're going to have to determine the differences, and then we're going to add them back on that Schedule 1. So for the lease, fairly straightforward. The amount that was deducted was $1,000. We're going to deduct the actual monthly maximum, which is $800. We'll multiply that out by 12 months for a grand total of $2,400. So the next thing we're going to take a look at then is the automobile allowance expense that was incurred. So we have to do a similar calculation here where we have 14 grand, which is the amount that was actually paid and expensed. And then we have to deduct what the maximum actual expense is. So per current year CRA prescribed rates, we have for the first 5,000 kilometers, this is our maximum per kilometer amount. So we'll multiply that by $5,000. We will then add 20,000 kilometers, right, the remaining kilometers, times the prescribed rate for any subsequent amounts. We're going to add both of those up and deduct them from the $14,000. That'll give us the total of our add back, which is shown right here. So we've got add backs of $2,400 for our Schedule 1, as well as any incremental amounts right here, add back for the auto allowance. Nice work, everybody.
Here are some examples of expenses that are expressly permitted as deductions for tax purposes, which may differ from their accounting treatment. Now, the first one is capital cost allowance. We know this is not an accounting deduction. It is strictly defined for tax purposes. Any interest paid or payable on any amounts borrowed to earn income or acquire business assets, interest is a permitted deduction for tax purposes. Any bad debts that are actually written off during the year, as opposed to, for example, an accrual for bad debts, this is bad debts written off during the year, actually written off when you determine you're not going to be getting the money back. Those are deductible. Any landscaping costs incurred during the year for business property, those are deductible as well. Utility service connections, generally you would capitalize that for accounting, so it's something that you can deduct for tax purposes, although this is a little obscure. We're a little into the weeds here. So tying to the TriStar example, we'll take a look at CCA that's been correctly calculated by TriStar's bookkeeper at $92,000. We also know that during the year TriStar re-landscaped the front of their headquarters. This $22,000 was capitalized for accounting purposes. We know that for tax purposes that's not right. So what are the Schedule 1 adjustments? Well, both the CCA and landscaping costs are deductible for tax purposes. Therefore, they have to be deducted. Well, I say they have to be deducted. They should be deducted. Again, CCA is a permissive deduction, so it never actually has to be deducted. But in all likelihood, a corporation would take that deduction to reduce their net income. So the effect on the S1 is you're going to deduct the 92 grand for CCA. You're going to deduct the 22 grand for the landscaping. All right, let's talk about convention or conference costs, which are incurred when you send your employees off to a convention. So can you deduct this for business purposes? Sure, up to 2 conventions per employee per year can be deducted from net income. The convention fees have to be related to the corporation's business in order to be deductible, but I think that goes without saying, hopefully. As an example, we've got TriStar, which paid to send their employees to various conventions. So they have an expense on their income statement, and it includes 4 conventions. So what are the Schedule 1 adjustments we have to make for this, knowing that we are only allowed to deduct 2? Well, given that you want your deductions as high as possible, I would say let's deduct the highest possible amounts, which would be this one, Convention 2 and Convention 4. These other 2, they're smaller, so we're going to add them back. Again, we're only allowed to deduct 2. We might as well deduct the largest ones. The ones that we're not allowed to deduct, the excess of 2, we'll add back. Let's take a look at what that is. So here are the Schedule 1 adjustments. You can only deduct 2 conventions. Deducting the highest cost conventions from income results in lower net income and ultimately lower taxes payable. So the 2 lowest cost conventions should be added back on the S1. We're going to add back 2 grand. We're going to add back 2,650, and that is how you deal with that. What about financing fees? Are these deductible for tax purposes? And it turns out they kind of are, just over a period of time. So financing fees are any share issuance costs or mortgage fees. That doesn't include interest, underwriter fees, etc. Any kind of lawyer fees that you could incur when trying to borrow money or issue shares, which is, equity fundraising instead of debt fundraising. So this doesn't include interest. Interest is deductible for tax purposes, so these are other costs that are incurred when obtaining financing. The costs are actually amortized over a 5-year period, and that's straight line, so 20% of the costs per year over 5 years. How this works in our Schedule 1 is that if 100% of the costs have been deducted for accounting purposes, 80% of them must be added back on the Schedule 1. Why? Because you're only allowed to deduct 20%. Again, for accounting purposes, 100% has been deducted. You can only actually deduct 20%, so adding back 80% is going to fix that right up. Here's what that looks like in TriStar. We've got TriStar having expensed $10,000 of financing costs incurred upon securing a loan. So what kind of adjustments would we make on the Schedule 1? Well, the answer is that only 20% of those financing fees are deductible in the current year. Because 100% of those fees were deducted on the income statement for accounting, you have to add back 80%. 10,000 bucks times 80% is $8,000. The effect on the S1 is add $8,000 back to accounting income. In subsequent years, we're going to have $2,000 deducted on the Schedule 1, and that's going to be for the next 4 years. All right, let's bring it all together here. We're going to do an entire T2 Schedule 1 for TriStar. So what we do is start with net income for accounting purposes that we were given at the very beginning of 742. Then we're going to do all of our add backs. So income tax, accounting, loss, the recapture, the salary, donations, depreciation, the write-down, the appraisal, lease, the mileage, the conference fees, and ultimately 80% of the financing fees. This gives us a total amount of add backs shown here. We're then going to take our deductions, the accounting gain, the terminal loss, CCA, landscaping for total deductions shown here. So we'll take our accounting income minus plus our add backs minus our deductions for our net income for tax purposes shown right here of this amazing number. Did you get it, guys? Well done. Good job. All right, on to the next video.